Imagine an ETF that is designed to lose money over time, not by accident, but by design. That fund is SH, and thousands of investors buy it every single trading day. SH is the ProShares Short S&P 500 ETF. ProShares launched it back in June of 2006, and its job is simple to describe but tricky to truly understand. For every 1% the S&P 500 falls in a day, SH aims to rise 1%. When the market drops, this fund climbs. It is a straight bet against America's 500 biggest companies. Despite that strange mission, SH holds close to $1 billion in assets. When the headlines turn scary and investors brace for a crash, money pours into this fund. It has become one of the most popular ways for everyday traders to profit from a falling market without opening a complicated short position. Under the hood, SH does not actually short a basket of stocks. It uses swaps and other derivatives with major banks to deliver the opposite of the S&P 500's daily move. And that one word, daily, is the key to everything. SH resets its exposure at the close of every single trading session. Here is what the marketing does not shout about. SH only promises to match the inverse of the market for one day. Hold it longer, and the math quietly turns against you. This effect is called volatility decay, and it can erode your money even when you are right about the market's direction. Picture this. The S&P falls 10% on Monday, so SH gains 10%. On Tuesday, the market bounces back to exactly where it started. The index investor is now flat, right back to even, but SH is down more than 2%. Each daily reset compounds from a new starting point, and in choppy sideways markets that drag never stops. The long-term record makes this painfully clear. Since it launched in 2006, SH has lost roughly 85% of its value. Over the past year alone, as stocks ground higher, SH slid by around 20%. This is not a fund that builds wealth. It is a fund that slowly bleeds it when held for too long. So who actually uses SH the right way? Short-term traders and hedgers. Someone who believes the market will drop this week and wants a quick, defined way to profit, or to cushion a portfolio for just a few days. Buy it, watch it closely, and get out. It was never built to sit quietly in a retirement account. And remember, if the market keeps climbing, SH keeps falling. Being early here is the same as being wrong, because every day you wait, both the decay and the 0.89% expense ratio chip away at your position. So here is my question for you. Would you ever hold an inverse ETF like SH for longer than a single day? Or is it strictly a short-term tool in your book? Tell me in the comments because I read every one. And if this finally cleared up how inverse funds really work, hit that like button and subscribe for plain English breakdowns of one ETF at a time.